What's going on, everyone? Disk and Young here. So today I wanted to go over some common real estate and real estate investing terms, some abbreviations, some just terminology that you guys want to know if you're going to be in real estate investing, okay? So the first one we're going to talk about is a classic, cap rate. You've probably heard this about 1,000,000 times, but what does it mean? If you want to put it in short, it is the rate of return. Cap rate is essentially the rate of return on an investment. This is found by taking the NOI divided by the purchase price or the prospective purchase price. So if you're thinking you're going to be paying something, or maybe you're offering less than the actual purchase price, you can also slide that number in there and find what your cap rate will be after that, okay? It's important to note that the cap rate does not include debt service. This means that it does not include the mortgage payment, because that varies so much that that does not include it. So you're gonna have to plug that in to find the true cash flow afterwards. Also, just so you know, most people do not say capitalization rate or cap rate or things like that. Most people say, hey, that's a 10 cap, hey, that's a 6.3 cap, something like that. They drop the percentage and don't use the entire thing. Just so when you're going out there, you don't sound funny when you're saying that. So, next one, gross rent multiplier. Gross rent multiplier I don't see come up very often, but it is the gross rent ratio of the price of the asset or the price of the investment relative to the income coming in. So it basically says how long or how many years it would take for the property to pay for itself, okay? So if you take all the income coming in and then you divide that by the purchase price, not including any of the expenses or things like that, it'll tell you how many years it'll take to pay this off. I don't see this used very often. I personally don't really use it, but it is on a lot of MLS multifamily sheets and things like that. So a lot of people do kind of generally want to know what it is. So that's what it is right there. All right, next one that we have is gross scheduled rent. Gross scheduled rent is the annual amount of rent that you receive for the property total. So if someone asks you what is the gross scheduled rent for the property, that is annualized terms, and that is for the entire year, all the money that comes in for the property. So that is gross scheduled rent. Next one we have is a big one, is NOI. NOI stands for net operating income. Net operating income is how much money you would make if you did not have a mortgage on the property at all. So that is the total amount of money net to you. Net operating income is critically important to understand and to know. It is used in a lot of formulas. Not only that, though, when you're looking at properties, analyzing properties, and you see that NOI, it's important to be able to see if it seems off or seems low or high, and being able to look at the expenses and things like that and come up with your own NOI, I think, is critical. I've found so many mistakes when I get someone's NOI and I get someone's cap rate and things like that, and then I actually do the numbers myself and I find that their NOI was wildly off. So NOI is found by taking the total income coming into the building, then you subtract any vacancy rate or vacancies that they might have, and then you take out the operating expenses. So the operating expenses would be things like taxes, insurance, maintenance, utilities, things like that that keep the building running and things like that. So you take all that out, you will be ending up with NOI, okay? So it's critically important to learn how to find NOI, especially if you're dealing with other people's NOIs. Never trust them. I always like to do my own numbers for sure. Next one, REO. REO stands for real estate owned. What the heck does that mean? I think this is a horribly worded thing for what it means. It means the bank owns the property, or it's a financial institution that owns the real estate. Why it's called REO, I have absolutely no idea. It's a really misleading term, I think. It's very confusing for people, but it's very typical to hear someone say, oh, it's an REO, things like that. So that's what that means. It means the bank or a financial institution own it. Next one, ROI. ROI is a return on investment. Return on investment is how much money and the rate of return for you on the money that you put in. So I use this a lot of the time for flips. Hey, how much money did I put into this? How much money did I get out? The only thing with this is it does not take into time how much time you put into it, take into effect how much time you put into it, sorry about that, or other outside matters and things like that. So it's truly just how much money did you put in and then how much money did you get out. So that is your ROI. Next will be the debt service coverage ratio, or the DSCR. The debt service coverage ratio says how many times the property's income could pay the mortgage. How many times could that property's income that's bringing in pay for the mortgage? A lot of the time when you're going through a financial institution to pay for a multifamily or an income property, things like that, they're going to have a limit or a floor to what the debt service coverage ratio can be. A lot of the time it's 1.25. Check with your local institution on what or whoever you're going through to see if they do have a floor. It can always be above that, so the property can always be paying 1.5 or 2 or things like that, but it can't go below that floor of 1.25 or whatever it might be for your circumstance. Next one, ARV. ARV is after repair value. I see this all the time in flipping and wholesaling. People that are into flipping and wholesaling, you'll see ARV mentioned all the time. ARV is after repair value. So this means after the property is fixed up and things like that, what could it sell for on the open market? What is the valuation after it's fixed up on the open market? This is critical, knowing if someone's ARV that they're giving you is accurate, be able to find ARV, whether that be you work with a broker or you're a broker yourself, or you're able to find other means to find that evaluation. This is very important, especially in flips. You have to make sure you're spot on with your ARV. If you're low, that's okay, but if you're way too high with your ARV and your profit's much lower, you're gonna wish you knew ARV much better. So that's an important one for sure. Next one would be 1031 exchange. 1031 exchange is a tax-deferred exchange. You hear this a lot of the time with people selling their multifamily. It is a way to defer their taxes and not have to pay capital gains when they sell the property. So they'll take that investment. This is only for investment real estate. This is not for owner-occupied properties, okay? So for investment real estate, when they go to sell, they can take those proceeds that they would have got and put it into another property using a 1031 exchange. When they do that, they are deferring the capital gains they would have had to pay to this new property. The only time you're gonna have to do the actually pay the capital gains is if you go to sell and realize your gain. Once you realize your gain, meaning you got the proceeds to yourself, then you're going to be having to pay your capital gains. But you can, most of the time, people try to defer forever and eternity, okay? So that is a 1031 exchange. You hear that a lot with multifamily or people selling rentals off for sure. Last but not least, IRR, or internal rate of return. Internal rate of return, this is used to measure the profitability over time. So this is more for long-term profitability of a property rather than just the short-term, what is the cash flow doing right now. This looks at over a period of time, the cash flow, the change in equity over time. The cool thing about IRR, or internal rate of return, is you can take a couple different investments and look at how they will do over the span of a couple years or whatever you might put for the year's amount, and see how that investment will do for you over a longer period of time rather than in the right now. So I really like to take it if you're looking at 3 different properties to potentially buy, run the IRR on all 3 or things like that, and see which one's going to do best for you long term. That is awesome to be able to do. Okay guys, so that is what I have on those. If you guys would like to know more about one of those, comment below or let me know which one you would like me to talk about more. If you have any questions on anything, let me know. Of course, like, comment, share, subscribe if you can. That would be amazing. Also, I run an Instagram page that's more entrepreneurial and motivational things and things like that. That's at diskin.re. Again, that's at diskin.re. Hopefully this was helpful for you guys. Let me know if you need anything else. Talk later.